Welcome to the InvestTalk Wealth webinar. And today we're going to talk about positioning your portfolio on profitability, relative price, and dividend payments. And today I am happy to welcome one of our newest members of our team, Luke Guerrero, coming over from Dimensional Fund Advisors. Welcome, Luke.
Thanks, Justin. Glad to be here.
Yeah, well, excited for our first webinar, and I think there's a lot to unpack during this. About 45 minutes, we'll probably try to keep it and try to get into the various factors that are driving portfolio returns, both near term and long term. And this is our agenda for the day, and Luke and I are going to kind of go back and forth on this, but I'll dive right in. And as always, I like to talk more big picture, and that is starting with the economic backdrop and the fact that companies continue to, whatever you want to call it, deglobalize, nearshoring, reshoring, onshoring. These are all terms that are being talked about on earnings calls in a big way. And it's not just talk. You look on the chart on the right, you can see the real manufacturing construction starts spending over the last 12 months are skyrocketing. This is in real terms. And this goes back to 1980. So you can see that really throughout the 80s and 90s and early 2000s, our manufacturing spend by corporations here in the US was pretty meager, and that's why our manufacturing base is really hollowed out. But now, as companies are seeing the fragility in supply chains and the problems that COVID created, they're really reinvesting in in the country and all of that. So this is a trend that is not really going away and is only accelerating. And then demographics. Entitlement spending is really driving the fiscal growth. Boomers are retiring. Now more baby boomers are retired than still working. And those are all people that are not paying taxes, and they're collecting Social Security, they're collecting Medicare, and that's going to be a big driver of the government spend over time. And our off-balance sheet liabilities, we've talked about that for a long time, about how all of these promises of entitlements in the future, we're going to one day have to be paid for. And that means they were off balance sheet at one point, and now they're becoming more on balance sheet. So that is more almost automatic fiscal spending, right? It's not one side of the aisle wants to spend more or less in a particular year. That's already legislated into existence. So that's a dominant part of our landscape of our fiscal side of the ledger here. And then on the monetary side, you can see with the COVID crisis, the banking crisis most recently, the Fed acts pretty quick, right? The Fed raised 25 basis points today, but they also had a dot plot that came out at 75 basis points of cuts for next year. So clearly they see a situation in not too distant future where they're actually cutting rates overall, and we'll talk about that in more depth in a little bit. But what you can see is the Fed is going to continue to try to paper over any problems, and they're going to be quick to react and in a pretty forceful manner. The fact that this recent lifeline they've given to a lot of banks allows them to put these bonds that are underwater. They're still good credit quality, right? Obviously that they have duration risk and they're down in value, but they put them back at the Fed at par value when they're trading sometimes at 70 cents in the dollar right now. That's a pretty big move, pretty big, bold move. And that's basically taking the losses of those securities onto the Fed balance sheet and off of the balance sheet of these big banks. And that's a big move. And so you can just see their reaction function is pretty strong. And the swap line that they announced over the weekend to the 5 other Western central banks around the world, Bank of Japan, Bank of England, ECB, and what am I missing? Bank of England, Bank of Japan. There's one more I'm missing. Bank of Australia? I think that's what it is. So those are the 5, and it's showing you there's noticeably absent Bank of China and obviously Russia, but you can see they're also going to be very more regionalized and keeping the Western banking system more shielded from those people that are, I guess you could call enemies in a way. And then you have a Fed pivot, most likely. We talked about that with that 75 basis point hike for next year. But this is really PTSD from '08. And this is the battle they're going to be fighting with for a while, which is inflation that's going to be structurally higher, but they don't want problems that are even similar to '08, right? Banks collapsing, no matter how small, it reminds everybody, investors and government officials, of '08 more than anything. So we're going to see this kind of a rolling set of features of the economy for the next probably 10 plus years. Now, more near term, you see that business leaders still, was this, I think was it 8 of the last 9 months? They had negative, this is a New York Fed business leader survey, so how confident business leaders are. And what's interesting about this is that we've had a negative reading for the last 8 or 9 months, but remember that this slide and the manufacturing spending on building new manufacturing capacity, that's in an environment where they're not very optimistic. Imagine an environment where businesses are more optimistic. I think that spending domestically is going to go up even more dramatically. And then on top of that, industrial production has been flat to negative for 6 out of the last 7 months. So that also is a feature of, hey, demand is not that great, but we're still going to spend on expanding capacity. So I thought that was interesting. And then real retail sales, that's been negative for 6 months or so, 6, 7 months in a row. This just shows you the consumer relatively weak. So a lot of things lining up to say the Fed is going to pivot, and that's likely to mean inflation, although coming down, will probably continue to come down, especially in the back half of the year as we hit different base effects. You're really going to see probably inflation pick up more next year, but in the near term, there's going to be a lot of reasons for the Fed to pivot. But if you look at the CPI breakdown, the headline numbers are still pretty high, right around 6%. But if you back out shelter, remember, shelter is very lagging. And the reason it's lagging is because you're still counting rents that were being signed back in June of last year when rents overall month over month were going up. But they peaked mid last year. And in fact, now they're going negative. And so if you back out that shelter component, it's really not a picture that shows really high inflation. Now, it's still elevated from pre-COVID levels. You can see this kind of red line down here, CPI less shelter. It's still not quite to those levels, but it's not a six headline, right? It's more like a 1 headline, and so that's something I really wanted to point out. And then the path of the Fed rate hikes, you see that here. We're at up to 575, or sorry, 475 to 5. So this will tick up after today's announcement, but they were at 468, I believe, at the close yesterday. And so we'll see what they actually get to. Maybe they only go to 475. Remember, this is a range, so they can be anywhere within that particular range. And then the yield curve has started to actually steepen. Now that is typically a very negative thing for the economy, or a signal for the economy, because it's signaling to the bond market that they're going to pivot. Now, before the pivot was usually done because of a recession, right? That was their main reason for a pivot. But because of the problems and the level of debt in the system, they're trying to quell any type of banking crisis, as you've seen. And so the impetus might not be a full-blown bad recession. It might just be the banks need it, right? And so that's what's interesting here, is that the market is starting to price in those Fed cuts pretty soon. Now, the Fed target rates over time, this is looking back to 1972. So all this is showing is that this is more of a normal Fed funds rate. When I was growing up, 5% on your savings account was not atypical. Now it's very atypical, although many of them are getting back close to that level, which is nice. But the point is, this is a more normal rate environment. The last decade plus has been an anomaly, and you can't expect that going forward. And this is something that's very important that I follow very regularly, which is the MOVE index. So everyone talks about the VIX and the volatility of equities, but what's frankly more important to the financial system as a whole is the MOVE index, which is the volatility of bond or interest rates in general. And you can see this one actually goes back pre-financial crisis. That spike over there on the left side started in '07 and peaked in '08. And it just shows you that the Fed they weren't doing a whole lot back then until there was a crisis. And then they did a whole lot to bring the volatility of interest rates down, and they kept rates down and suffocated them for the better part of more than a decade. And then you have that spike here more on the right side in the red. that was the COVID crisis. It was a quick spike up, and then the Fed once again, because they have PTSD, they reacted pretty swiftly. And now you're back above, about once you get above the 150 level, this is where liquidity in the treasury market and the bond markets get not very good. And that's the signal. And it's the signal to the Fed that they need to step in and do something about it, whether that is lowering rates, whether that is getting rid of QT or going into QE, whatever it is, the Fed does not want to see this get out of control. And so this is definitely something I'll be watching. And it's a good barometer for what's happening in the bond market. With that, just I want to pivot over to Luke. He's going to kind of go over value and profitability investing and what that means for your portfolio and how to construct it.
Thank you, Justin. Now, before we start to dive into the ideas behind value and profitability investing, I wanted to talk a little bit about some general principles that you should be thinking about when considering any factors or any strategies that you're using to structure your portfolio. So these 5 principles are things that I like to think about anytime I'm structuring any portfolio. First and foremost is what you're doing, does it have an economic basis? So one example I like to think about is for a certain period of time, companies that started with the letter A outperformed other companies. Did it happen? Yes. Does it make any economic sense at all? Absolutely not. Because of that, you probably shouldn't structure your portfolio around a strategy like that. Does your philosophy apply broadly to markets? Should you be applying something that only applies to the US software tech space to an overall holistic approach to a portfolio? No. The next 2 help to defend against what we like to call data mining. So no matter how you slice the data, no matter what metrics you're looking at, do you get the same result? Is it just a fad? Did they cherry pick a time sample, a time series, rather than looking at the entirety of the data? And lastly, and most importantly in my mind, is it cost effective? There are plenty of ways to structure your portfolio that aren't cost effective. A lot of people have momentum strategies, for example, because the research and empirical data has shown that securities that exhibit positive momentum tend to continue to do so in the short run, and securities that exhibit negative momentum tend to continue to do so in the short run as well. However, the turnover of these strategies tend to be in the realm of 4, 5, 600%. So you want to make sure that whatever you're targeting, that you can approach it in a cost-effective way, such that what you are doing to capture those premiums is not eaten away by the costs to achieve it. And as you'll see, value and profitability pass all of these tests. And value investing is not anything new. One of the earliest and most well-known value investors was a man by the name of Benjamin Graham, who some of you may be familiar with. And he taught us some valuable lessons about investing in general. One thing that Justin likes to talk about on InvestTalk, and certainly something we talk about all the time, is treating a purchase decision of a company in the right way, knowing that you're going to become a partial owner of that company. So Ben Graham would say, would you be willing to buy the whole business? Another important lesson is you should not conflate share price with a company's value. And that really goes along to lesson number 3. Some of the most dangerous investments to make are in companies that are highly priced. Think about people that bought Tesla when it was at an incredibly high multiple, bought Tesla at the top, and rode it all the way down. Investing should not be treated like a casino because it's not gambling and it's not speculating. Again, you should be thinking to yourself, would I want to buy this whole business? Because in the short term, markets are a voting machine, meaning that they are whipsawed by the behaviors of various individuals, but in the long term, it's a weighting machine. They derive the true value of the companies.
One of my favorite quotes is, you can chase performance, but you'll never catch it.
That's an incredible quote. And you see that too in terms of fund flows over time and where people are throwing their money at. They tend to chase returns. So this is why we wanted to talk about this today, because we wanted to create a framework for you to think about long-term investment. Now, Ben Graham's intuition in the late 1940s regarding value investing was far ahead of his time. It would take several decades of evolution in investing theory to arrive at models that show how a company's value and profitability can help to explain its future returns. So I know this slide can be a little confusing, but let's go through it step by step. So in the 1960s, Bill Sharp created the capital asset pricing model. And on the left side of these equations is what you see RIT minus RFT. That's what we call the company risk premium. So what are you getting in your return of a company in excess of the risk-free rate? So by taking on the risk of investing in a company, what are you garnering in excess of if you just held that in treasuries? And that
And
company,
I think for the first time, and a lot of people are thinking about that, right? Because now you can get 5% on a treasury. And people haven't been thinking about that for a while because they always thought equities are going to perform better than the 2% they're getting on Treasury, right? So this is the time where this capital asset pricing model is pretty pertinent, right? And finally, I think these are concepts more people can grasp a hold of now because they're looking at rates that are reasonable.
yeah, absolutely. But really what it's saying is that the expected return of a company is equal to alpha, which is some unexplainable component of return, plus something which I think you've all heard of, which is beta, which is sensitivity to the performance of the market. And that was really the predominant model for almost 3 decades until Gene Fama and Ken French expanded upon it. And you'll notice 2 additional terms. So this is the 3-factor model, the second line. The first is SMB. And what this is saying is they saw in the data by doing a cross section of returns that small cap securities over time tended to outperform large ones, and that a company's market value can help to attribute to its expected return. The next one is HML. So that's going to be high book to market securities minus low book to market securities, or what we think about as value securities minus growth securities. And like I said, this really expanded upon a long thought out process that created the capital asset pricing model, saying that, okay, it's more than just how sensitive a company is relative to its market, relative to the market. It has to do with the characteristics of those companies. And 2 decades later, they expanded upon that model to add 2 more factors. RMW, which is a high profitability portfolio minus a low profitability portfolio, and asset growth and how a company grows year over year. Now, of these 5 factors, the ones that have been the largest explainers of return are the first 4. Your sensitivity to the market, meaning are you invested in equities, your size of the company, the value characteristics of those companies, and the profitability characteristics of those companies. So these are the 4 things that we really think about when we're structuring our portfolios. Now, this is all theoretical, and models tend to be oversimplifying explanations of the real world because they exist in environments that we call frictionless, meaning there's unlimited liquidity, there's no trading costs. So what we really want to do is show you how value has performed in the real world over time. So this next slide is showing us value in this millennia. So on the far left, you'll see the year 2000, and on the far right, you'll see the year 2022. So you'll notice that over the first decade in this millennia, that value securities greatly outperformed growth securities. And then it started to converge after 2010. So what really happened in the second decade? Well, interest rates, as we all know, were historically low. It was incredibly easy to raise capital. It was incredibly easy for companies to grow without having profits. And because of this, you see this conversion of value and growth performance to the point where you see value slightly outperforming growth as we get to 2022 and we start to see the turnaround that Justin's been talking about. But remember, we mentioned it's important to not look at sub-periods of data, but rather everything that is available. So going back as far as we can, which is to 1923, that's as long as book value data has been available, we wanted to show you what would it look like if you took $1 in 1923 and invested it in the return that would be the difference between a value and a growth portfolio. And
You're
in that
basically saying go long. Are you saying go long value and short growth?
exactly,
In effect. Yep.
exactly. So looking at that over 100 years, that $1 compounded would have grown to $30 by that strategy, even with the massive dip that we saw in the 2010s. So this is a long track record of value outperforming growth.
Yeah, and
And do we
basically
see
this last decade plus has been an anomaly.
exactly, exactly. And remember that we mentioned, it's important to look at it for profitability as well. So is this something that we see in profitability as well? And in profitability, we don't have data going back as far. Slide back. We only have data going back to 1963 in terms of the actual income statements of a wide enough amount of companies that we can draw a determination. But in that time period, we see the same result. We see if you invested $1, long the profitable, short the least profitable securities, that dollar would have grown to over $6 in that time period. So we've shown empirically how value and profitability have outperformed over time, but rather than just leaving you with some sort of complicated formula and some chart to show this relationship, I wanted to convey it to you in a way that'll show why it's sensible based upon how we think about how we value bonds, companies, cash flows, anything like that. So
Any
this
type
is
of
really
asset.
just any type of asset. So this is really just a broad framework for understanding, the value of an asset. And it's not a real mathematical equation, like I said, just a framework, but in essence, the value of something is equal to its future cash flows divided by some discount rate. This is a very simple present value framework of thinking about something. So how does this relate then to value versus growth? Well, if you think about, if you think about, thank you. If you think about what generates a company's future cash flows, the future cash flows of a company are going to be generated by its return relative to its assets and its assets. So mathematically, if that discount rate, which is really the expected return of a security, is something we're trying to discover and we want to have a higher discount rate, if two identical companies have the same exact price and the same exact return on assets, but one has a higher asset value, the only way for those two companies to have the same price is if the higher asset value company has a higher discount rate, meaning higher expected returns, which is why we want to look for companies that have higher book values relative to their price. And similarly, you can think about that in terms of profitability. So you can think of the future cash flows of a company being related to its operating profitability. So if two companies have identical prices and one has higher operating profits, the higher operating profits one must have a higher discount rate, therefore a higher expected return. Now, given everything we've talked about and how much the world has changed over the past 100 years from which the data and evidence comes, do value and profitability still make sense? And to us, the answer is yes. Because if you think about, again, how you're valuing something, your future cash flows, gross securities are going to have a lot of their value derived from anticipation of higher profits in the future. As interest rates are rising like they are, those profits in the future are going to be worth less today. Whereas value companies with strong balance sheets tend to have the profit realization now. Now, strong pricing power and strong balance sheets are going to help companies position themselves better in a rising rate world. If companies that have low debt levels and strong balance sheets have a better time of raising capital, they're less affected by rising interest rates. And this is something that we learned about for nearly a century worth of data, which has shown that values outperform growth in periods of high inflation. And as Justin mentioned before, and something we talk about a lot, is there is a shift towards deglobalization. So these companies with strong balance sheets with low levels of debt and stable earnings means they are consistently able to combat these shifts. And here's just an example of what we wanted to show you today of places and industries, sub-industries where you can look for companies that have better relative valuations and higher profitability. Now, before we talk about how we integrate everything together, I'm gonna pass it back to Justin so he can talk a little bit about dividend income investing.
Yeah, I mean, and dividends are certainly an important part of being dividend investing in a way is value investing because in order to pay a dividend, you have to be over time consistently. Uh, you have to have a business that is consistent. You have to have dividends that you have to be able to produce cash flows to pay those dividends over time. And in times of economic stress, a company with excessive profits will be better positioned to keep that dividend stable and if not grow it and reinvest money into a weak economy, weak market, a weak sector, and they'll come out the other side much better, as opposed to companies that maybe have rougher balance sheets or more shaky business models. Those are things that are a problem in a down economy. And so it's paying a dividend over time consistently is a signal of strength of that business. And this chart over here on the right is, I think, very instructive because it goes back to the 30s and it shows you the dark blue is where the returns of dividends come from, and the light blue would be the price appreciation. And what you can see, and then the yellow triangles are, not triangles, diamonds, are the inflation rate. And what you can see is that dividends are a very important part of the total return calculation. And the real return is very important, because if inflation is super high, like it was in the 70s, total return, including dividends, was still, 5-7% or so for that decade, but inflation was 20%. And so, if you just relied on price appreciation, you were even further behind, right? Same with the 80s, right? 80s inflation was still relatively elevated, but without dividends, you were falling behind inflation. And so you can see that in inflationary environments can be difficult for equities, but the dividend side, the dividend stream is important to keep up with that inflation rate. Now, dividends in periods of high inflation, as Luke was saying, dividends tend to grow, and those type of companies tend to outperform because of the things I said previously. And you have a smoother investment experience, right? Less volatility. And the next slide really shows that. And it's not just about paying dividends at all, it's about paying the right amount of dividends. A lot of people chase dividends, and that would be over here on the far right, the highest 10 percentile. And the yellow bar is the volatility. And what you can see is this kind of smile, where average dividend payers have some of the lowest volatility. Okay. Now, they don't quite have as high returns as the ones that pay kind of above average dividends, but their volatility is relatively low. And as you get above average, that's where the volatility starts to peak up a little bit, right? But when you get into that top percentile, companies are paying 10, 12, 15% dividends. There's a reason for that. And so what you can see here is they actually, total return is actually less than those that are just paying above average dividend rates. So when you're looking for dividends, we always say this all the time, don't chase those high dividend payers, look for above average to average dividend payers. Those are going to be much better risk versus rewards, okay? And then what are the kind of pros and cons of dividend investing in general? Now, first is passive income. You don't have to do much, right? If you're investing in real estate, for example, hey, you're a landlord, you got to pay, you got to deal with tenants, etc. That can be a problem, right? Passive income is always nice. Smoothing out the outcomes, as we said, less volatility from dividend payers. Qualified dividends, that's huge, because when you go buy a bond, the taxable bond, that's taxed at your ordinary income tax rate. And there's limits on the gains from long-term capital gains or qualified dividends. And so that's a huge benefit, especially in taxable accounts. Then you can set up drip campaigns. That's always nice as well. Now, the drawbacks are they can be pay out too much, right? Not all dividends are sacrosanct. They can certainly cut those dividends at any time. You have immediate taxation, whereas, like, say you're buying a company that doesn't pay a dividend. Berkshire Hathaway is a good example. They don't pay out dividends. They just reinvest the money. The price of the security goes up over time, and you can take that tax hit by selling part or all of your shares at your discretion. Whereas dividends, you have to pay that tax in a taxable account if you're paid in that particular year. There can be dilution if they're paying out the dividend and they're issuing shares to pay out that dividend. That's something that can be a thing, so you have to watch out for that. And then slower company growth. If they're paying out that dividend, that's less money going to projects that could potentially grow the business overall. Now, history says that's actually kind of a good thing, because it kind of keeps their eyes very focused on the return on their investment for their projects that they're putting excess cash flow of the business into. So overall, that's a good thing, but their growth tends to be more along the lines of average to below average, and sometimes that's actually a good thing. And in fact, some data says that lower asset growth is actually tends to be better. Other considerations: you're buying a REIT or an MLP, that's taxed at ordinary income tax rate. Owning MLP in a tax deferred account, that can be an issue, and tends to, like I said, dividends tend to keep management decisions in check. So I'll pass it over to Luke, and he'll talk about principles of all of this in practice.
Yeah, thanks, Justin. Knowing what we know now, how do we structure our portfolios at KPP? What metrics do we consider, and how do we balance some inherent trade-offs? So first, I just wanted to show you some commonly used metrics for value, profitability, or sometimes people call it quality for earnings quality, and dividends. So value, we're talking about price to book, right? What is the price of a company relative to its book value? What's its enterprise value relative to its EBITDA or its price to earnings growth? For profitability, you can look at operating profit scaled by book value. That's my personal favorite. That's telling you how many dollars of profit are you getting per dollars of book value you have. It helps to tell you how you're utilizing your assets. What's your return on equity or your return on assets? For dividends, we're looking not just at dividend yield, but what's that payout ratio? What's the free cash flow like? Do they actually have a sustainable way to continue to funnel cash to investors? But remember, one of the 5 things I talked about at the beginning of this is that it's important that no matter how you slice the data, it's telling you the same thing. And looking at all of these things are telling you the same story. But the difficulty in implementing a strategy that considers multiple prongs is that they tend to be competing, and it's important to properly balance trade-offs. So this is just an example. I took 10 names within the industrial space. And on the far left, I sorted them by price to book value. And then in the middle, I sorted them by operating profit per dollar book value. And on the right, by dividend yield. And what you'll notice here is that none of these lists are the same. And that's because, like I mentioned, there tend to be some competing aspects to these things. So how do we balance these trade-offs? Balance the competing premiums, because like I mentioned, value and profitability can be competing. There tends to be a correlation between as something becomes more growthy, it can become slightly more profitable. So we practice an integrated approach. We look at all of these metrics and we have a proprietary blend and a scoring system. We don't just rank them on the entirety of the US market. We're separating it by size because we also have to be cognizant of the size characteristics of companies because of what the 3-factor models taught us. But really, it has to be a careful approach. And an important lesson, which we've talked about before, is you shouldn't just purely invest in the highest dividend paying stocks. Similarly, you shouldn't just purely invest in the high prof stocks or the most value oriented stocks. And the last 2 things I wanted to touch on was that this is really only applicable to traditional equities, right? REITs, for example, are things that you can buy on the open market, but they're not really representative of the equity asset class. It's real estate. And highly regulated utilities don't really have the profit motive that a lot of normal businesses do. So, you have to exclude this from this framework as well. But generally, like I mentioned before, this framework, this philosophy is important and it's powerful because it's broadly applicable. But still in all, it's still just a framework and a basis for how you can focus your attention and structure your portfolio. And it's important not to fall for some of these value traps. As we mentioned, I'll hit it again. You don't want to just be searching for what has the highest dividend yield. You have to review dividend history for growth and consistency. You have to look at these companies' balance sheets. You have to always have in the back of your mind the macroeconomic environment, the potential distributions and technologies and potential competitors. For profitability, are these profits just a unique facet of what's been happening recently, or is it in tune with long-term trends? So these are all things that you need to keep in the forefront of your mind whenever you're structuring portfolios. And that's really something that we can help you with by doing portfolio reviews, which Justin's going to talk about now.
Yeah, and I'll finish that last part up with kind of the way that I think about it. And everyone has their own sense of it, right? We all bounce around ideas, and we have our own sense of what matters most. But for me, profitability of a business is most important. It goes back to, do you want to buy the whole business? How profitable is that business? Not just today, but going the last 10, 20, 30 years. How consistently profitable are they? And that's something you really have to pay attention to, because at any given time, for any given reason, like COVID, there can be companies that really knock it out of the park for a short period of time. But is that a flash in the pan, or is that something structurally changing about the business? So I really like to focus on that. But those valuation metrics are also important. You have to mix and match and weigh them because they all have merit and they all have their own value. Now, let's talk about a portfolio review is what we typically do for clients. No obligation. I do this video conference pretty much with clients and listeners, and we review goals, we break down portfolio weightings and risks, and it looks something like this, where we look at sector exposure, right? This is just one example. You have the different 11 different sectors. Is this person was 18% technology, they were 34% healthcare. Is that something that makes sense in this environment? No, because they were underweight energy, only 5%, underweight basic materials, less than 1%. But then the broader asset allocation, what's the bond exposure, stock exposure, cash, any other types of assets, bond maturities. Are you in long-term bonds? Are you in more short-term bonds? And then style factors, that's down here on the bottom right. So, this person, luckily, they were leading on the large cap value, so that's good, but they had very little in mid and small cap value as well. And so everyone's portfolio is going to look a little bit different, but it's important to break down these characteristics. And you can see here we have dividend yield, you have PE ratio, price to book, expected growth rate. So we can break down all of these for all these different positions, and then where you're underweight and underweight compared to the particular sectors. So I think it's a great way that we really hone in on what type of portfolio somebody has, where the risks are, where they're overweight and underweight, and how that fits as well with their goals and their risk tolerance levels. Because everybody's different, right? Just because your cousin or your brother or your best friend has a particular portfolio doesn't mean that's perfectly right for you, because you're a different age, you have to come from a different place, your goals in retirement are going to be a bit different. So these are all things that we talk about on our portfolio review process. So these are 4 of our 5 different strategies. We have another one that's all bonds, but basically from left to right, we have least aggressive all the way to the most aggressive. And so you can incorporate the left 2 on the left are focused more on dividends and bringing in income through bonds, as well as the dividends. Equity income is more bringing in call premiums as well as the dividends. And the other 2 on the right will have a mix of both dividend payers and non-dividend payers, but they are pretty aggressive as well. So if you want to reach out and schedule a call, it's pretty simple, right? You can go over to our website, KPP Financial, and you can click on portfolio review, and we will schedule a call. You get a link to my calendar, and then we can jump on a call and then do this report for you. So with that, I'll get into some Q&A with you, and let me try to share my other screen. Yeah, here we go. So I'll get into some questions here. Let's see. The first one says, how the wars help the economy? Has the war been used as a means to come out of bad economic situations in the U.S.? Will the Ukraine war benefit any specific industry and overall economy? Well, it's inflationary. The bottom line is, I'll actually go back to this slide. Go here. Pull this back up. Let's go back to, switch these over. Go back all the way to this slide. Where's dividend? There we go. And what you can see here is obviously you had the inflationary environment of the 70s, but you know what else was inflationary? The 1940s, which was World War II, right? So war is inherently inflationary, whether that's a trade war or a hot war. It disrupts supply lines, disrupts supply chains, and it's the antithesis of productivity, right? If you're at war, that means less people working, less people producing goods and services for the broader economy, and it's just massively inflationary. So that's definitely that. George says, I realize you folks are mostly investment driven, but do you folks think life insurance should or can be used for guaranteed tax-free income retirement, even though it projects 3 to 4% dividend growth? I think for some people, fixed annuities can be a fine choice. If you're very low risk tolerance and you don't want to pass anything on to the next of kin, then I think a fixed annuity can be reasonable. I don't think it's right for everybody, but that's the only type of life insurance or I guess annuity you would call it. Never buy life insurance as an investment. If you want to buy life insurance, you want to be buying fixed life, never whole, never universal. I said this on the show, I don't know, 2 weeks ago. I've been doing this for 20 years. I've never heard one person in my career that was happy they bought universal whole life policy. Not once. I've talked to thousands of people and probably hundreds of people over that time about whole in life, that have bought whole or universal life. 0% of them are happy they bought it. Right? Hope that helps. Angar says, do you see impact of current situation in agriculture industry? Will it be affected, especially with fertilizer companies? Yeah, I mean, it already has. The cost of gas is an input that goes into artificial fertilizer, and that certainly impacted the price of fertilizer. I think overall, this is definitely going to be inflationary for the fertilizer industry. Angar says, would Playboy be considered growth, speculative, or value? Probably speculative, right? Considering it's that small. Definitely not value. And here says, what do you think would be normal Fed funds rate moving forward for the next decade? Well, I think that the Fed is going to be battling, as I said before, they're going to be battling inflation, a structurally higher inflation because of these other factors, right? So we can go back to, I'll go back all the way to here.
Yeah, and it also goes back to what Chairman Powell said today during his statements, which is, for the foreseeable future, if things start to deteriorate within the banking system, then certainly they would consider pausing for the foreseeable future, but they still see a terminal rate that is higher eventually than what we are at today.
Yeah, and I think this chart that this is a more normal Fed funds rate, I think that's certainly going to be true. I think they're going to try to keep Fed funds rate relatively high, but only is so high as they don't destroy what is most important, which is the financial system, right? The treasury market. And so I think they're going to try to keep it high, but only as much as they can control the financial system and the treasury market. So that's something that they'll be fighting with for the next decade plus.
Yeah, I think one more important thing too is that the 2% inflation target was emblematic of a post World War II world, where you had globalization increasing, essentially what seemed like permanent peacetime, and what Fukuyama called the end of history. So as we're moving into a different phase, it's entirely plausible that that 2% inflation target is no longer applicable.
Yeah, and I'm sure they'll eventually probably let go of that at some point. Ron says, do you still like energy stocks? I do. I think that this recent dip is more of a buying opportunity. Jess says, do you see natural gas prices recovering? Yeah, I mean, natural gas prices are certainly volatile. There's been a shutdown of some export facilities out of Texas, and those are recently coming back online. That's certainly going to help push some of that domestic supply abroad. Let's see. Sherry says, I have a brokerage with a mix of dividends and non-dividend stocks and ETFs. I opened this account prior to obtaining a job, offering benefits 401k IRA. We better stop buying dividend-paying stocks in my brokerage, instead buying them in a Roth or an IRA to take advantage of tax implications. Yeah, that is definitely something to consider when you are trying to decide where to buy particular positions. We talked about REITs and REITs are actually especially good in a tax deferred account like an IRA or a 401k, because if in a taxable account, they're taxed at your ordinary income tax rate, whereas in a tax deferred account, they don't have the problems of an MLP. You can hold as many REITs in a tax deferred account as you like, and there's no major tax implications there. So that's really the main one that I say that's typically better to buy within an IRA or so. Bryce says, why is volume important? Are we talking average volume or today's volume? Volume is always important, right? Liquidity of a particular position. So we always look at that, right? We have, I'll show this. Yeah, I mean, this is volume down here. We have other charts. I'll pull up this chart. This is the S&P. Right, so looking at volume, what I typically use volume for is more for what's happening intraday, right? So if something in a downtrend, for example, and it has big volume, that can be a signal that the trend is going to change. So that's what I typically look for. The spiders, it can be difficult. It's more for individual stocks that we look at volume.
Yeah, it also matters for if you think about the price you're going to pay to get into or out of a position. If something's very thinly traded, right, spreads are going to be wider. It's going to cost you more to get in and get out of it.
Yep, exactly. Let's see what else. In this environment, is copper a good buy? Should I wait to see if there's a recession for a better buying opportunity? Well, we can look at JJC. It's a copper ETF. technically it's fine, right? It had that pullback on a very strong dollar. The fact that copper has gone nowhere in the last year in the midst of a very strong dollar overall is a pretty bullish sign overall for me, right? This is the dollar, and I think there's certainly some headwinds with the slower economy, but there's a lot of tailwinds with the green energy movement. So that's why we still like copper overall. This is a good one for Luke. As AI keeps getting better, do you think this might have an impact on value versus growth investing?
Sorry, can you say that first part again? I couldn't hear you.
As AI
As
grows,
AI
do you
gets
think this
better.
could have an impact on value versus growth investing?
Here's what I would say to that, and that is the fundamental economic basis that underlies value and growth in investing has held since 1923. As the technological curve gets ever more steeper upward and things keep progressing within industries, I haven't, and nobody has really shown me any research that has shown that that trend hasn't held. So my take would be that even as technologies advance, specifically AI, value will over the long term still outperform growth because of the economic sensibility of why it happens.
Yeah, and I like what you said. We were talking about this yesterday, actually, in office, and Luke made a good point that a lot of people focus on the companies that are developing AI technology and less
Mhm.
on the companies that are going to benefit from the AI technology. Those companies that are going to have a less of a workforce because they're going to rely on AI. And so they're going to be able to squeeze the economic value out of AI in probably a much bigger way than AI companies themselves.
Yeah, exactly. One in 1,000 AI companies will become super successful, but any industrial company that utilizes artificial intelligence will have better bottom line performance.
Exactly. Yeah. Aaron says, do you think growth will still outperform value short term? This is a good question. And the answer, I think, is actually yes, because of that Fed pivot. We talked about how lower interest rates help growth companies, higher interest rates help value companies. And right now, I think you've seen kind of a peak. Let's go to the 10-year. The 10-year peaked back here in October, and it should be not a huge surprise that this is the Russell 3000 growth versus value. So when this is declining, it means value is outperforming. When it's rallying, that means growth is outperforming. And recently, you have growth outperforming because interest rates are coming down. And then on top of that, there are a lot of regional banks in the small cap value space or just the value space in general. And so certainly they've been underperforming and dragging down the value side of the market. So near term, it would not shock me to see a bounce here and a continuation kind of near term. But what you can see is this trend overall is still down since the highs in 2020, and we don't expect that to change. But you're always going to get these counter trend rallies, right? You've got a counter trend rally in growth over value from May of 2021 all the way until the fall. So that was a good 6 month period where growth did outperform, and you're going to see those. It's not like that you're not going to have those. With the charts we showed earlier were very long term. So make sure that you don't get shaken out of it because and focusing more on the economic value that Luke has been talking about. Donald says, what are your comments on the last half hour of the market sell-off and the market's read on the Fed meeting? Luke, what do you think?
Yeah, I think the Fed message was exactly what people expected. I think maybe some people didn't think there'd be a second hike that they anticipate doing in May, and that could be why there was a little bit of a broad sell-off. But I think most of it is related likely to the Treasury Secretary saying that they wouldn't take more extraordinary measures to effectively blanketly backstop every deposit across the United States. So I think that probably dragged down some regional banks and dragged down the market overall.
Yeah, I agree. Lewis says, oh no, Walt Paul says, how important is RSI in your evaluation? I would say it's important. We like to look more on charting patterns versus just RSI, but certainly you want to see companies outperform. And I know Luke, you guys did a lot of work over at Dimensional when you were over there on momentum factors. So why don't you talk a little bit about that?
Yeah, exactly. So, I mentioned momentum before, and you shouldn't really structure a portfolio around it because it has inherently higher turnover. So, when I was at Dimensional, the way we looked at momentum is we kind of did buy and sell exclusions, right? We had broadly diversified portfolios. So, when a security was exhibiting positive momentum, we would delay selling it if it was one of the sell candidates because typically securities that are trending upward continue to trend upward for historically the next nine months or so. And on the opposite side, we would tend to not buy securities that were down momentum because typically we could get a better price for that. So it's just one of the aspects of a holistic approach of not only structuring portfolios but also investing in individual names that we do take into consideration.
Yeah, that makes sense. Things that outperform in the near term tend to do so, right? A lot of people jump on that train and they want to ride it, but when companies start to exhibit negative momentum, then they veer back towards fair value, and so that's what you want to watch out for. Those kind of overvalue names are losing momentum. Those are the ones you want to certainly get out of quickly. It's here it says why gold as a hedge hasn't worked out yet. I mean, I think it's worked out, right? Look at gold. Talk about the dollar being strong over the last year. Look how strong gold's been. This is just this weekly chart. This is the broad consolidation pattern after a large move higher from 2016 onward, and now it's starting to break out once again. It had a pullback recently, but it now didn't even test the 100-day moving average, and we're now making a new higher high here. And I think they're going to attack. I think we'll be at new highs by the end of the year. So, if the Fed does pivot, that's certainly, I think the gold will continue to be strong as the market continues to price in a more dovish Fed going forward. And a 75 basis point cut next year certainly goes along with that. Taylor says, is the banking sector as a whole something to sell with this volatility, or do you see volatility calming down over the coming months and years? I certainly think it's a near-term issue that they're going to have to solve, and I think they're going to solve it with more dovish policy, with these emergency measures, and overall, this isn't affecting the big banks, right? Money is going there. Banks fail. That's just what happens. But unless some of the top, I think the top 10 banks have 50% of the assets of the entire financial system. So unless one of those top 10 banks fail, which the Fed certainly would not allow that, I don't really see this really being a systemic issue. Now, could it create a weaker economy 3 to 6 months from now because a lot of those banks lend to the real economy versus some of those larger banks? Not so much, right? They do more M&A and things like that. But I would say yes, there's some potential impact there. But just another reason why the Fed is likely to this. I think it's the last hike for the cycle. What do you think, Luke? Think it's the last one?
Well, I think they still might do one more hike, but I don't see them doing more than that. But as of today, if things remain static, I would assume there would be no more hikes. But I also want to point out, when you're thinking about the long-term effects on the banking sector, ask yourself, how were banking profits 5 years after the 2008 financial collapse? And the banking sector didn't go anywhere. And that was way worse.
Yeah, George says, what if all my 401k and Russell is in Russell 3000 mutual funds and ETFs? Do you like that, Luke?
Well, one of the things that I used to say to clients at Dimensional is indexing is a great way to start. But there are things you can do to improve upon your, potential, expected returns and investment outcome. So indexing is a great place to start. But I would say maybe depending on your situation, try and diversify into some things that take a little bit more active risk to try and build some wealth.
Yeah, and it's definitely yeah, it's a good place to start. Yeah, but you can improve on it, right? Because most indexes are now leaning growth just simply because they're market cap weighted, and that's a little bit less so over the past year because growth has underperformed. But it's going to take a lot of time for growth to be underweight in the indices. It took basically 5-6 years after the first dot-com bust for value to be the leader within the broader indices. So we're only a year or two into this process. Jason says, or no, sorry, M. Shaw says, what are the current technicals on growth names like Microsoft, AMD? Would you look to buy? Well, I'll show you Microsoft because this is an interesting one. This is a series of lower highs and lower lows, right? Simple as that, right? Same with AMD, right? These are not names that they're sexy and they're exciting, and this is really what this webinar was about, right? Is that these names are fun and interesting, but what's fun and interesting doesn't always align. Usually doesn't align with what is profitable, especially over the medium to long term. You can always get counter trend rallies But unless they are priced reasonably and have consistent profitability, then they're likely to revert over the long term back to fair value. And as Ben Graham said, right, over the long term, it is it's a weighing machine of earnings. And AMD's business historically is very cyclical. Microsoft is also to a degree cyclical, especially with so many people in the business community wedded to Microsoft 365 products and Microsoft OneDrive. We use it here at KPP. So when people lay off workers, guess what? They're going to be canceling a lot of those type of subscriptions, especially in the tech industry. That's where most of the layoffs are concentrated right now. So both names, while technically they've certainly improved, they're not nearly as strong as, say, the industrial space. You can see how relatively strong this has been, pretty much flat over the past year versus Microsoft AMD down. That's an example of growth, value beating growth.
Yeah, I think a lot of times people try and swing for the fences on some names rather than realizing that boring, stable business is typically the best thing to invest in.
Yep, exactly. I'll take one last one since we're 1 minute left. Dan says, would it be good to use the dividends for retirement income without selling any equities unless absolutely necessary? So basically, what a lot of people do with like a bond, right? They just live off the dividends. And yeah, I mean, if you can get enough dividends to pay for your retirement, I think that's a great way to go. Remember that, especially if you have money outside of a tax deferred account. I think that is a great place to put your dividend income in. In a tax deferred account, there's more of an argument for that because no matter what, when you take the money out, it's taxed as income to you. That's more of a personal situation. That's something I dig in with clients all the time, is how to produce income from their portfolio in retirement. So I would encourage you to schedule a portfolio review. We can talk about where you're at, what makes sense for you, how to shift your portfolio so you can produce more income and do it effectively, do it safely, so that you're not getting companies that are cutting their dividends or anything like that. And that's probably the biggest risk of dividend investing in retirement, are those dividend cuts. All right, well, I thank you all for attending. Hopefully Luke and I gave you a good overview of how to think about value investing and structuring your portfolio in times like these, which are especially unique and interesting. I know that for myself. And hopefully you can take some lessons here, apply them to your portfolio. And if you think you need help, don't hesitate to reach out to us. You can head over, I'll show you show you where to go. If you want to run a portfolio review, just go to KPP Financial, click on portfolio review right here and fill this out, and we will get back to you and schedule something. So thank you all for attending, and we'll talk to you on InvestTalk soon.
Wonderful day.